to the next portion, we need to prepare the retained earnings statement. Now it says here, before preparing the 2013 retained earnings statement, determine the correct balance as of the beginning of the year. So what I'm assuming they mean by that is, our ending retained earnings statement is correct? No, it can't be, because our net income is really $25,970. So let's go and see what we need to do here. The beginning retained earnings shows $59,300. Assume, let me just see. Before preparing the 2013 retained earnings, determine the correct balance.
They were saying that there was an error in last year's income statement of $1,650 that needs to be corrected for. I don't know the line items if you go up.
Yeah. It's on the expense and profit statement.
Less
Of
overstatement in
$38.50.
last year's income.
I'm sorry, guys. I'm trying to see where you're talking. Where is it?
Under less, where it says less.
Okay.
Cost of operation.
Correction of overstatement in last year's net income because of error. Net of $1,650 income tax credit, $38.50. Okay, so basically what there's, since this happened after the end of the period, okay? So what we'll do is we need to come up with a new balance. Got it. So we'll start with a 59.3. We'll start with this 59.3. Then we're going to show our adjustments. We'll say less the prior period adjustment, correction of the overstatement in last year's income. Net $1,650 income tax credit. So that if they overstated the net income, that means our retained earnings is higher than it should be. Does that make sense? So we really need to subtract $38.50. Okay? And now we're going to come up with what we call an adjusted retained earnings as of 01/01/2013. 59.6 minus the 38.50 gives us 5. Would it be 55? 450?
Yep.
Okay. Now we need to add our net income. How much was our net income?
From the adjusted that we did?
Up here, 25,970. We know that's right. So we now have a new balance of 55,450, and 25,970 is 80,430? No. 55,450.
81,420.
God. Guys, I don't have a calculator on me.
There is a calculator in Excel.
Well, I don't think it works, though.
Yeah, you can.
It does. If you do
You can
equal
use it
sum,
sometimes.
Oh, the equal?
yeah, delete equal sum. Yep, or you can do plus that too.
Okay, it did. I'm sorry.
That's fine.
For some reason,
Trick of doing that on there, you do the
You can't do the sum of the.
this sum isn't working, you see?
equal on there.
No. If you do, it does.
On my,
If you just type it in, yeah. If you
okay,
Yeah, the auto sum doesn't work, you can manually.
That's on, okay.
Yeah.
We're using
got
the
it.
sum, we have
I
to-
know, I'm used to, okay, now what are we going to subtract? What do we subtract from here to come up with our ending retained earnings?
Dividends.
Dividends. So we're going to show our dividends, less, I should say. Of 4,000. And what would our retaining earnings be at the end of the year? 77,420? How many of you get that? How many of you would like me to go over something again? Are you pretty clear on this?
Can you scroll up for a second? Are we gonna fill out the retained earnings part or the compound right there? Those
Earnings per
boxes?
share.
Oh, I'm sorry. Yes,
Earnings per share.
earnings per share, absolutely. So how many shares are outstanding?
8,000.
8,000 shares, okay. Income from continuing operations. Our income from continuing operations is 29,120. What is it if we take 29,120 divided by 8,000 shares?
$3.64 a share.
$3.64 per share. Now let's look at discontinued operations. 1,050 divided by 8,000 shares.
About 13,125.
13 cents. And then let's look at our loss. Our $4,200 loss divided by 8,000 shares.
$0.53.
But that's a minus.
Yeah.
So,
And then your net income divided by the 8,000 shares.
well, that would be all these.
All those added together.
So 430? No, that doesn't sound right. 364, 13 cents, minus 53 cents.
You have to add the negative 53.
Yeah. So if you
Yeah,
do
it's 320.
delete that real quick, and then equals, and then type in sum.
Type in some.
And
Oh!
then parentheses,
Yeah,
And the right
like
parentheses.
Lotus.
yeah. And then just select this one that you want, there you go.
You know what, I lived with Lotus years ago. So when this new one came out, it just confused me, because I was used to typing on my
There's formulas and whatnot.
formulas. Oh, I get to go back to Lotus. Okay, so 324, or, yeah, perfect.
Mine rounded up to 325, but.
Well, did you have 12 cents?
I
for?
just did the long decimal. I did.
Yeah, 325 is really what the book says, but I'm just,
Okay.
Yeah, because I think the extraordinary loss has to be negative 0.52.
Yep.
And then it'll be okay.
That's right.
0.53 actually.
okay, minus point,
I got 0.53.
I think there's like a rounding error with that.
Yeah.
Yeah.
I'm
1
sure.
cent off is not really gonna kill anybody. is it?
Okay, no. I'll give you credit even if you're a penny off. Okay, any questions on this, guys? How are we doing? Are we happy?
Yes.
So let's go to the next problem. And who, is it 11 or 10?
16.
Problem 16?
Yeah,
Yeah.
that's the cash flow statement.
Oh. Okay, so I should probably go back to the PowerPoint so we can talk about cash flows. So let me go back here because I skipped this, but let's go back to cash flows. Okay, so let's look for a few minutes back at the PowerPoint on cash flows. Now, we know our statement of cash flows is divided into 3 sections: operating,
Financing.
financing, and investing. Now, think about it. Users want to see that the majority of income's coming from operating, because that's how why the business is in existence anyway. So they want to see how money is being used and comes in and goes out in a business. How much is from operations, what sources, and how much of that money did the company keep so they can invest in it? How was it financed? So a statement of cash flows is required along with the income statement, balance sheet, and statement of stockholders' equity. So the basic importance of this cash flow is to see really how the cash is spent. So basically, we know that when companies are having a hard time meeting their cash demands, chances are they're not going to be around much. Cash is king. Yeah, we want to make revenues, but you got to make sure you get that money in a timely manner, and that you are a good budgeter of your money. So the cash flow statement definitely is helpful in users determining, is this company going to be a viable operation in the future? It helps people see if companies can generate positive cash flows. Are they able to meet their debt obligations? And how are they investing? How are they financing their activities? You really get to see the big picture in that cash flow section. So basically, it allows them to see how much money gets raised from stock, how much money is getting raised from other sources of debt or liabilities, and then they also can see the net income from the company versus what they've really brought in, the cash that they've brought in. So we know there are 3 sections. I want you to know about this. The operating section we know is about the money coming in and going out for the reason the company's in business. So the operating section is going to include monies in, monies out for everything to do with the reason the company's around. Investing activities relate to buying and selling property, equipment, intangible assets, long-term investments, lending money, and collecting on loans. So it's how they're investing in the company, how investments are being handled. Financing is all about borrowing money or stock. Transactions involved in obtaining resources from owners, paying dividends to the owners, repurchasing shares such as treasury stock, and then getting money from long-term liabilities, lenders, bonds, and also repaying those lenders and the bonds. So as you see here, and this is important to know, operating is everything to do with the company. Paying salaries, the money coming in from set revenues, and the money going out for inventory. Investing has to do with buying items and selling investments. Buying investments, selling investments, buying equipment. And financing has to do with either selling stock or liabilities. Not just the acquiring of them, but the paying them back also. Does that make sense, guys? So basically, there are 2 ways that you can create a cash flow statement. One method is called the indirect method. The other one's called the direct method. We're going to do the indirect method. We start with net income. We start with net income, and then we're going to add back and forth our various items where at the end of the period, our December 31st cash balance should equal what we have in the bank. So net income gets listed first, and then we make all these adjustments. Some things we're going to get rid of. think about net income. We show in net income depreciation expense. Do we really fork out any money for depreciation? We don't. So really, we need to add